Welcome to the MUFG Global Markets Podcast. I'm Jonathan Wong, and today I'm joined by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, March 4th, 2025. Welcome back to the podcast, George.
Great to be back on.
George, in our most recent monthly titled The Ides of March, we dived into the Senate and House budget plans as well as growth assumption behind their models, which we highlight could be a bit optimistic. Without going to the full details, what are the medium-term risks around the fiscal implications from this budget process?
Yeah, I think this is really now starting to become a big focus for markets in addition to the tariff concerns. There's a lot that's being tackled down by the administration down in DC. And the fiscal spending cuts that are coming from the Department of Government Efficiency, the DOGE, the concerns around upcoming budget for March 14th deadline, the reconciliation of the various bills that will address the budget needs, but also the potential extension of the tax cuts that are in place but set to expire at the end of the year, the lifting of the debt limit. And I'm probably sure I probably forgot something in between there, but there's a lot of sort of policies that have to, in procedural things that have to get done until we get an actual final budget in place. And I think the markets are now finally reacting to it. And some of the assumptions as we kind of went through in the piece, trying to understand where could there be cuts and where is there potential savings there, and how feasible and likely is it to get actually implemented? What are the growth assumptions and therefore revenues that would come into the government? And then the ultimate implications will be if there is a shortfall and inability to self-finance some of these measures, it's going to result in more treasury supply, more debt, and I think all these things are being played out. And I think right now the market's concerned about other forces like the short-term concerns around tariffs, but in the back of everyone's mind is this concern about the fiscal outlook, the debt sustainability, and these deficits that have been massive over the last couple of years. And is there a risk that some of these plans that are being proposed and budgets are too optimistic and therefore actually might make the fiscal outlook even more dire? So I think it's a process, and we progress somewhat, but I do think that the markets are definitely getting concerned about it.
Thanks for that. And yeah, the broader markets are experiencing a risk-off episode that has lasted now for well over a week, where the tone has quickly switched and Fed funds markets are now pricing in a 50% probability for a May cut. How much do you think is priced in right now when it comes to the current growth scare? And have rates markets gone too far?
Yeah, no, it's a great question. And again, markets have finally taken notice on just the changing backdrop and a clear shift from inflation expectation concerns to more the growth expectations, this growth scare as it's being called. A number of factors have kind of contributed to that concern. The overall spending by the consumer has taken a shift lower post the holidays in Q4. There's also been concerns around the tariffs. Was there a pull forward of activity last year ahead of the change in administration? And therefore, now that we have less spending capacity on a go-forward basis, consumer confidence has taken a nosedive as well. And that plus, although people are discounting it and being a little bit dismissive of it, but we've had a pretty big swing in what is known as the Atlanta Fed GDP forecast, which went from a positive expectation for Q1 to now pretty deep negative early on with their first preliminary readings. I think all of that has led to this risk-off behavior, concerns about the upcoming NFP, which I know we'll get into in a second, and the tariffs. Plus, what we've been highlighting for quite some time, starting points matter, and the valuations were pretty stretched for a lot of these sectors within the equity markets, especially the tech sector. And I think been a repricing, probably justifiably so. And now the question is it priced in enough? Is the Fed priced in enough? Because And we have now basically roughly 3 cuts priced in. Our house view is for 2 cuts this year. We could be convinced for more cuts versus less cuts, but we do think at a minimum 2 cuts is the baseline. And now we've gone through that. I think we maybe a little bit too far. Perhaps with that nearly 100% certainty of more than 2 cuts, as well as this growth scare, I would say that we're probably 60% priced into a more negative outcome of maybe not a full-blown recession, but a very shallow growth for the balance of the year. And for it to get much worse from here, we would probably need to see further proof, which I think it really comes down to a further deterioration in the jobs market, which we'll get an update on Friday.
As you mentioned, if we look forward for the rest of the week, we have NFP on Friday. And given that it is the first payroll reading under the new administration, what are you watching out for? Will we see any flow through of the government buyout, Doge cuts, or other federal job downsizing?
Yeah, so our understanding is, and we're going to be doing a more formal preview. So for those that do receive our content, please be on the lookout for that. We'll put out a more official NFP preview, but just a preview to the preview. The concerns about will there be a reduction in government jobs? Has all of these changes in the last month had enough time to filter through? Our understanding is that it's probably too soon, and maybe in fact we won't see these job reductions until well into the summer, but we'll see based on just on when they're accounted for, at least in the actual headline job reading. But where there could be some spillover will be in the unemployment rate, which right now a Bloomberg consensus shows it at 4%, which was a downtick from the prior months, also going down to 4% from 4.1. I think there's more upside risk to the unemployment rate going back up to 4.1. If those that have lost their job or are poised to lose their jobs, actually answer the survey in a way that suggests that they don't have a job. And I think we'll be watching, even if there is no negative job growth in the federal count, the lack of job growth there, plus hiring freezes at other large states. So state and local government might see a pullback as well. And then for every government job, there's multiple jobs that are impacted by it on the margin as well. So there can be a pullback there. So we are expecting a weaker number, but I think given how much is priced into the bond market, it would have to really be a very weak number, potentially verging on negative, for it to actually sort of substantiate the price action so far, at least from what I can tell. And I think we've kind of moved a lot. If it's a really bad number, then sure, then I guess the market can rally further on the bond market. But I think we've priced in a lot of this sort of negativity already. And it's going to take, I think, more than just 1 month under our belt to get a full, clear grasp of the impact of these federal changes. I think it's going to take many months, not just one. So we'll see.
Thanks again, George.
Thanks, Jonathan.
We would like to remind our listeners, for those that would like to receive George's strategy reports directly, please email your MUFG sales coverage or get in contact with George directly on email or Bloomberg. Thank you for listening to the MUFG Global Markets podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts, and reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets research team.